All right, so I'm going to do this chapter's videos a little bit differently. So this is chapter 5, and this is XYZ Corp, and it's number 12 on the practice problems, and it's also very similar to one of your homework problems. And the reason I'm going to do this one differently is I'm going to do this one in parts. And all of the parts are not going to be on this video, so this will be part A, okay? Because if you look at this problem, there are parts A through E, and so this video is going to contain part A. And the reason I'm going to do this is because otherwise the video would get to be really long, and I think it'll be more convenient for y'all if I do it in pieces. So what we're going to do is, for part A, we're going to reconcile book income to taxable income. So we're going to go book to tax, and we're going to look at book to tax differences. And we're going to discuss which ones are temporary and which ones are permanent. Okay. Now remember, the book talks about temporary and permanent differences. So remember, temporary differences happen in a year and then reverse over time. So these reverse over time. Depreciation is a great example. Permanent differences never reverse. So it's something that is deductible for book purposes but is not deductible for tax purposes, or vice versa. Excuse me. And an example of a permanent difference would be fines and penalties, right? They're deductible for book purposes but not for tax purposes. And then we also have favorable and unfavorable. And if we always think about these from a perspective of taxable income, okay, I think they're easier to keep straight. So a favorable book to tax difference means that taxable income is less than book income. And an unfavorable means that taxable income is greater than book income. A great example of an unfavorable book to tax difference would be penalties and fines. An example of a favorable book to tax difference would be interest income from municipal bonds. All right. These are both examples of permanent differences. All right. And you can have obviously favorable and unfavorable temporary differences as well. I just thought it made sense to keep the examples similar. Okay. All right. So now let's work our way through part A. And so we've got this income statement, right? And it's all based on book income, and we're going from book income, to taxable income, okay? And as you look down the list, you'll see things that have little numbers by them, all right? And those things will have to consult the notes to make an adjustment, all right? So let's just start with the first item. So revenue from sales, there's no note attached to that one, so there's no adjustment needed. So book income and taxable income are the same. All right. Cost of goods sold, similar situation. So our gross profit number is the same. All right, so our first item with a note is this income from investment in corporate stock in our chart. All right, so what do we have to do? So in order to make income go down, and it's temporary and favorable, so what does that do to taxable income? All right, so next we have to deal with interest income. And there's a note on interest income as well, so let's go take a look at that. So let's find our interest income. And again, that is going to decrease our taxable, but this is going to be permanent and favorable. So what is that going to do? That's going to make our taxable interest income only $8,000. All right, so now let's talk about capital losses. And capital losses don't have a number beside them, so you don't have to look at the notes, but there are things we have to remember about capital losses. So for book purposes, corporations can deduct a capital loss. But what do we know about capital losses from a corporate perspective as far as taxes are concerned? So capital losses are not deductible for corporations in excess of whatever their capital gain was. So we have to remember here that capital losses can be carried back for 3 years or forward for 5 years, and it has to happen in a particular order. But for right now, in this particular instance, they don't get to recognize this capital loss. So what that means is we have to adjust this capital loss, and this is going to be a temporary adjustment, and it's unfavorable because for tax purposes, they do not, right now in this current year, get to recognize that capital loss. They may get to carry it back in future years, or they may carry it forward in future years. Now let's look at this gain or loss from the disposition of fixed assets. So there's a note by that one, be an ordinary gain. So what do we have to do from an adjustment period? From an adjustment perspective? Well, book and tax are going to be exactly the same for that $3,000 of gain. That is going to be $3,000 of gain for tax purposes as well. All right, what about miscellaneous income? There's no note about miscellaneous income, and there's nothing fundamentally concerning about miscellaneous income from a tax perspective. So there's no change there. So what that does is then give us the ability to calculate gross income from a tax perspective. And gross income from a tax perspective is $13,261. Okay? Now we get to deal with book tax differences with respect to all of their expenses. All right, so the first expense we have listed is compensation, and there's a note. So what this information tells us is that they have not violated the tax rules around reasonable compensation. So there is no book to tax adjustment here. So they get to deduct the entire $7.5 million of compensation. All right, so now we're down to stock options, and there's a note related. So let's look back. And so stock option compensation for book purposes, that amount that's vested, that $200,000, is a deduction for book purposes, but it is not a deduction for tax purposes. All right, so for tax purposes, where is that? There we are. We have to add that back, and that is a permanent difference, and it is an unfavorable difference because now we eliminate that deduction. All right, next up is advertising. We're not given any information that there's anything strange going on with advertising. Advertising is absolutely deductible for tax purposes, so it does not generate any kind of a difference. So we just move that same amount over. Repairs and maintenance, same deal. Absolutely deductible for tax purposes. Rent, we're not told anything is going on that's unusual with rent. Okay, now bad debt expense. Now bad debt expense we have to pay attention to. All right, so let's go look at our notes related to. So what I would do then when you're looking at bad debt expense, okay, and you know what they actually wrote off, okay, so then I would, over here on the tax side, you know they actually wrote off $27,000 of bad debt expense. What adjustment do I have to make in order for my deduction to only be $27,000? Okay, so what I need to do then is adjust $14,000, that is temporary, and did it decrease or increase my taxable income relative to my book income? Well, it increased my taxable income relative to my book income, so that is an unfavorable adjustment. Okay, now we're on to depreciation. Depreciation is one of the most common sources of book to tax differences, so let's no more, no less. So what do we need to do? Well, I would do the same thing that I did for my bad debt expense. I would come over here. We know what our deduction for depreciation is allowed to be. It is $1,900,000. All right, so we are going to have to make an adjustment. We are going to have to increase our depreciation expense, right? So that is going to be a $500,000 adjustment. That is temporary. Remember, depreciation is a temporary adjustment. Is it favorable or unfavorable? Well, our deduction just increased, so our taxable income goes down. So this is a favorable adjustment. All right, so now we're on to warranty expense. And there's no actual deduction for tax purposes. So their deduction for warranties is 0. So what is our adjustment? Our adjustment is $70,000. It is temporary because they may pay warranty expenses in the future. We can assume they would. Is it a favorable or unfavorable? That is an unfavorable adjustment because we essentially lose a deduction when we move to the tax method. All right, so what are we up to next? We're up to charitable donations. Let's pause on that one for a minute, and we're going to put a little asterisk by that because we're going to deal with charitable contributions in a minute. All right, let's talk about meals. What do we know about meals? All right, so hold on, let me do this. Let me highlight this. Oops, that was not highlighting. That's highlighting. That's a little better. Okay. Now, what do we know about meals? We know that for book purposes, meals are a business expense, they're completely deductible. But what do we know about meals from a tax perspective? We know that only 50% of meals are taxable, are deductible for tax purposes. So what are we going to have to do? We're going to have to adjust that by $9,000. That is going to be permanent and unfavorable. Okay. And now we can deal with goodwill. All right, so let's look at goodwill. So for book purposes, they've deducted $30,000 for goodwill impairment. Okay, but there's a note. Now we have to go back and look and see what our adjustment is going to be. All right, so they've deducted $30,000 for impairment, but we just said that we get to deduct $10,000. All right, so what does our adjustment look like then in that situation? So then we have to adjust our goodwill deduction by $20,000, and that is temporary. Okay. And is that going to be favorable or unfavorable? Well, our deduction went down, so our taxable income goes up. So that is an unfavorable adjustment. All right, next up is organizational expenditures. And as we should expect, there is a note related to organizational expenditures. So let's go look and see how much that total was. All right, so their total spent on organizational expenditures was $44,000. So let's go back. So where are we? We're at organizational expenditures. Their total deduction is $7,600. All right, so now I have to figure out what was my adjustment to get from $44,000 to $7,600, and that's going to be $36,400. That is a temporary difference. It is absolutely unfavorable. Okay. All right. Now we're down to other expenses. We can just move our other expenses over since they're the same for tax purposes. All right. And now the last item that I want to deal with before we talk about charitable donations and the dividends received deduction is this provision for income taxes. All right, and there's a note associated. So what do we know about federal income taxes? They are not deductible for tax purposes, right? They're deductible for book purposes, but not deductible for tax purposes. So our deduction related to taxes, federal income taxes, is zero. So that's going to give us a $400,000 permanent and unfavorable adjustment related to taxes. All right, so now we have to kind of rearrange things just a little bit because we have to deal with charitable contributions, and the dividends received deduction, okay? And so the reason we've moved these, or I'm moving them, is because of the rules around calculating charitable contributions. So let's go back to the note. Our taxable income before charitable contributions and dividends received deductions. Okay, we don't have any carrybacks to worry about. So now we need to add kind of a line here. Okay, and so what we're going to have to do is figure out, based on the laundry list of all of our income and deductions for tax purposes, what is our taxable income before charitable contributions and the dividends received deduction. All right, so once we add up all of our taxable income and subtract all of our deductions before our charitable contributions and our dividends received deduction, I get, hold on. Cannot write today. So I get $2,220,400. Okay, that's what I get for that. So let's go back. Now, what did they deduct from a book perspective? From a book perspective, they deducted $500,000. All right. So what are we allowed to deduct? We are only allowed to deduct okay, that's our charitable contribution. And then what is our book to tax difference? Well, our book to tax difference is whatever it takes to get us from this $500,000 to that $222,040. So that's $277,960. That is a temporary, all right, and it's unfavorable. All right, sorry for squishing it together there. That's okay. And then we still have to deal with our dividends received deduction, okay? So we got to find some information about our dividend. Have to go back, and our dividend received deduction is $130,000. Did we have any kind of a deduction for book purposes related to our dividends? No, we did not. So this would be a permanent, and it'd be favorable because it's an added deduction, okay? And so that is going to give us our taxable income. And so our taxable income is going to be all right. So that is the end of part A. So let's take a look at our notes. So note 1 says XYZ owns 30%. That is a key number of the outstanding Hobble Corporation stock. Hobble Corporation reported $1 million of income for the year. XYZ accounted for its investment under the equity method, okay? And it recorded its share of earnings for the year. It also, HC, also, so Hobble Corporation, also distributed a dividend to XYZ. Okay, so let's take a look at all of those things. So let's talk for just a minute about the equity method. Okay, the equity method applies when you own at least 20%, but less than, I should say not more than, 50% of the distributing corporation stock, okay? So what does this mean? So under the equity method, what this means is XYZ is going to recognize their pro rata share of income, but not the dividends. So kind of the nuts and bolts, the therefore is and their pro rata share is 30% of that $1 million. But under the equity method, they don't recognize the dividend. And this is for book. Now, what do they have to do for tax method, for taxes? For taxable income, so for taxable income, XYZ has to recognize the amount of dividends received. All right, so that's one. So let's look back at one because we want to make sure we understand what's going on. So for book purposes, they're going to use the equity method. And so what are they going to recognize as income for book purposes? I never put the actual number in. They're going to recognize $300,000. That's fine. What are they going to recognize for tax purposes? Well, for tax purposes, they're going to recognize the dividend, which is $200,000. So what is their book to tax difference? And is it temporary or permanent? So book to tax, all right, the difference is $100,000, okay, because you have to correct essentially from recognizing $300,000 of income to recognizing only $200,000 of income. And that is going to be a temporary difference. And is it going to be favorable or unfavorable? Well, their income is going to go down. Taxable income is going to be less than book income. So that's going to be favorable. So now let's go back. All right, so let's look at the interest income. All right, so we've got $20,000 of interest income. All right. 5,000 was from a city bond. 7,000 was from a city bond. 6,000 was from a taxable corporate bond, and 2,000 was from a money market account. Money market accounts are also taxable. So what does that tell us? Well, let's come down here and we'll look at number 2 and let's talk about interest. Remember, municipal bonds. Give us tax-exempt interest. So what are we going to have to do? Well, our book to tax is going to be a $12,000 difference. And tax-exempt interest never reverses. So this is going to be a permanent. And is it going to be favorable or unfavorable? Well, again, since it's going to take some of that interest out of our gross income, it is going to be favorable. So we can go back and make that adjustment. Notes, because there is a note about the capital equipment. And so, no, there isn't. That's about the gains. Let's go look at the notes. And it says, this gain is from equipment that XYZ purchased in February and sold in December. So they haven't had it for a year, excuse me. So it doesn't qualify as a 1231 gain. So it's not going to be a capital gain, so it won't get netted with that loss. All right. And it's going to compensation. So let's go take a look. All right. And so item 4 says that this compensation includes total officer compensation of $2.5 million. No one officer received more than $1 million in compensation. Well, why do we care? Well, we care because there's this thing called reasonable compensation from a tax perspective. And what reasonable compensation says is that you cannot deduct, you can pay a corporate officer as much as you want, but you cannot deduct for tax purposes more than $1 million per each officer, okay? Stock options, so let's go look at that note. So number 5 says this amount is the portion of incentive stock options, that's very important, that vested, also important, during the year, and the recipients are officers. So remember, there's a difference between incentive stock options and non-qualified stock options. All right, and we're going to talk more about stock options in class. But incentive stock options, you're allowed to, for book purposes, expense the amount that is vested each year. Bad debt expense. All right, so bad debt expense. All right, so it tells us in note 6 that they actually wrote off $27,000 of its accounts receivable as uncollectible. Okay, so what they actually wrote off is deductible for taxes. Okay, take a look at the notes and see what the notes say. Tax depreciation was $1,900,000. When it tells you tax depreciation was a certain amount, that is the amount that you can deduct for tax purposes. That's it. Out with the warranty expense. So let's take a look. So here's warranties, number 8. In the current year, XYZ did not make any actual payments on warranties it provided to customers. So what does that tell us? If there are no actual payments attached to that, and we know that goodwill is a source of some differences from a tax perspective. So let's look at note number 10 related to goodwill. All right, so on July 1st of this year, they acquired the assets of another business, and in the process, it acquired $300,000 of goodwill. At the end of the year, they wrote off $30,000 of goodwill as impaired. Okay, so let's come down here a little further. All right, and what do we know about goodwill? Goodwill is amortizable over 180 months. Okay, and so what did they do? They have a $300,000 goodwill over 180 months, allows them to amortize it, and that gives us, whoops, $1,666, 667. Okay, but what do we know? We know that they acquired this business in July, so that's 6 months. And so times 6 months, that's $10,000. So what do we know? We know that they are allowed to deduct $10,000. So this is the goodwill deduction. All right, let's take a look. Okay, so we got to scroll back up, make that big enough that we can see it. All right, so item 11, XYZ expensed all of its organizational expenditures for book purposes, and they expense the maximum amount allowed for tax purposes. Okay, so they expensed everything that they spent for book purposes. It's very important to us. All right, so let's scroll down and let's talk briefly about organizational. Okay, so what did they do? They spent and deducted $44,000 for book purposes. Okay, why is that important to us? Well, that's very important to us because remember that there's a limit on organizational expenditure, amortization, and deduction for tax purposes. So remember, for taxes, if total organization expenditure is less than $50,000, then can immediately deduct $5,000 for tax purposes, right? And amortize the leftover, okay, over the course of 80 months. Or excuse me, not 80 months, 180 months. Okay, so total spent was $44,000. So tax deduction equals $5,000 plus okay, so you've got that 5,000 plus what's left after you subtract out that 5,000 from the total, divided by 180 months. And since they started up their business in January, they get 12 months of a deduction. So this is the formula to figure that out. So 5,000 plus this gives us 39,000 over 180. Oops. So what is 39,000 divided by 180 times 12? It's $2,600. So then their total tax deduction is $5,000 plus $2,600, which is $7,600. Okay, so that's their total tax deduction. Go take a look at our notes and see what other expenses. All right, here we go. The other expenses do not contain any items. Okay, so let's go look. So this 13, this is an estimated tax provision related to federal tax expense. Assume they're not subject to any state income taxes. Okay. And see what it says. So it says on 9, XYZ made $500,000 of cash contributions to qualified charities during the year. All right, so let's come down here. And let's talk about charitable contributions, okay? Because corporations are limited in how much they can deduct for tax purposes. So for tax purposes, they can only deduct 10% based on their modified taxable income. All right. And so what is modified taxable income equal? Well, remember that modified taxable income is very situationally dependent. Okay. So with respect to the charitable contributions for corporations, okay, modified taxable income is taxable income before you deduct charitable contributions, the dividends received deductions, and capital loss carrybacks. Now, any excess can be carried forward. Okay, so we need to make sure we state that excess contributions. Oops. Can be carried forward, but only for 5 years. Okay, they don't get to be carried forward indefinitely. So based on all of that, what do we have to do? Well, we have to go back and calculate, back here where we were looking at our charitable contributions, what do we know? Well, we know that our charitable contributions are 10%, are limited, right, to 10% of that income before charitable contribution and dividends received deduction. So we're limited to $222,040. That's what we're limited to, okay? Received deduction. So let's take a look and find that. So our dividends received deduction, where did it tell us that? It talks about, oh, here we go. So that was note number 1, right? Where we got the $200 of dividends, okay? But what do we know about dividends received deductions? Well, dividends received deductions are based on our percentage ownership, right? So I'm going to come down here, scroll past all of that, and let's talk about dividend received deduction briefly. All right, and the percentages lay out like this. If you have less than 20% ownership, then your dividends received deduction percentage is 50%. If you're at least 20, but less than 80% ownership, then your DRD is 65%. If you are 80% or more for your ownership, then your dividends received deduction equals 100%. So in our situation, what do we know? We know that they were a 30%. Okay, so we know XYZ owns 30%, right? So the dividends received deduction equals their $200,000 dividend times, 65%. Hold on, I'm going to erase and make that a little bit neater. So that is $130,000. And so that's their dividend received deduction.